Okay. Okay, today's lesson is process costing. Now let's see what is process costing. So process costing system is employed in mass production. Industries where like units usually pass through a series of production stage, which are called processes. Process costing is suitable when homogeneous products are manufactured in large volume. You know, homogeneous products are almost similar products in nature. So when we are going to produce it in large quantities, we can use process costing systems. Job costing versus process costing. Later in this chapter, you may able to learn what are the costing methods such as job costing, batch costing, likewise. Now here, we are going to compare the difference between these job costing and process costing. Job costing assign cost to each individual units of output because each unit consumes different quantities of resources. Just take example of a garage. In a garage, that particular garage may get different jobs. Sometimes tinkering jobs. Sometimes engine repairing cost. Each cost is different. Each job is differs. Therefore, they have to calculate individual unit of cost separately for that particular job. Whereas in the process costing, it does not assign cost to each unit of output because each unit is identical. As I told you earlier, we are producing homogeneous products. All the products are same. So, we are not going to assign cost for each unit. Instead, what we are going to do is, we are going to take the average unit cost. Now, let's see some examples of industries that are suitable for applying process costing. What are the industries we can use process costing? Chemical industries, oil, cement, textile, plastics, paints, flour, glasses, food processing, and mining. So here you can see a similarity. What is the similarity? You can see a similar kind of output in these industries. Take example of cement. All the cement is same in each packet of cement bag. All the paints are same in a paint bucket. All the floors are same in a floor bucket. So you can see here all the products are homogeneous. When we are producing homogeneous products in large quantities, we can use this process costing system. Now, let's see various processes in garment factory. In a garment factory, once we receive fabrics or once we ordered fabrics, then the first step is we are going to send it to the cutting department. Once the block is cut, then the output of that particular department is sent to the sewing department to sew the fabric. After complete of sewing, then they will send it to the finishing department. This is where ironing is taking place, labeling is taking place. After completing the packing and ironing, they will send it to the final finished goods warehouse. So you can see there are several processes involved in the garment factory. Input of one department will be output of the other department. So likewise, it's move on. The output of cutting department sent to the sewing department. Output of sewing department sent to the finish department. Output of finish department is sent for the final warehouse. So first we are going to send all the direct materials, direct labor and overhead for the first process. These are the inputs of the first process. Then output of the process 1 will be transferred to the process 2 as the input. At the same time, we are going to put additional direct materials, direct labor and overheads as input in the process 2 as well. Once the process is complete, the output of process 2 will be sent to process 3 as input. Then we are going to put some additional direct materials, direct labor and overheads to fulfill the production process in the process 3. Then the output of process 3 we can recognize as the finished goods. The cost of finished goods we are going to recognize as the cost of goods sold. Now let's see flow of cost in a process costing system. In the process costing industry, production moves from one process to the next until the final completion occurs. Each production department performs some part of the total operation and transfers its completed production to the next department, where it becomes the input for further processing. The completed production of the last department is transferred to the finished goods stocks. So you can see the flow of cost in the process department. Now let's see the cost accumulation procedure. Control accounts are established for each process or each department, and direct cost such as direct material, direct labor, direct equipments, direct expenses, and the manufacturing overheads are allocated to each processes. So you can see all the direct cost as well as indirect cost is accumulated into the control account. Now let's see accounting for process costing. Costs are accumulated by each processes, as I mentioned you earlier. Each processes maintains its process account, such as process 1 account, process 2 account. Likewise, they are going to maintain their own process account. The process account is debited with the cost incurred and credited with the goods completed and transferred to the other process account. So you can remember that in the process account, I have debit all the inputs and output I have transferred using the credit entry and debiting the next process account. A completed unit of one department become the raw material of the next department. When the goods are completed, they will be transferred to the finished goods account. Once they completed, then only it's transferred to the finished goods account. When the goods are sold, the amount will be transferred to the cost of goods sold. There can be closing inventory, but here cost of goods sold only represent the goods that are sold. Now, let's see the format of the process account. So you can see the debit side and credit side. In the debit side, we have direct material, direct labor, and production overheads. In other words, manufacturing overheads. In the other side, you know the output in the credit side, and there is something new for you, that is the normal loss. So let's see this process A account. So in the process account, you can see material, labor, and overhead in the debit side. Then the output of process A is transferred to the process B account. So in the process B account, you can see other than the output from process A, you have other inputs as well. So you have material 50, labor 150, and overhead 100. Altogether, the output of process B is transferred to the process C account. So in the process C, you can see the input from process B. At the same time, you can see other additional inputs of material, labor, and overhead. The final output of process C is recognized as the finished goods, which is worth 1,500. That will be transferred to the finished goods account. Here, we are transfer the one we have sold into the cost of goods account. So you can see in the finished goods account, the output of process C is there. The only thing which we have sold, that only we are going to transfer it into the cost of goods sold account. So the balance represents the closing inventory of that particular organization. Now let's identify process losses. Every production have their own losses, such as in the processes. Here, the first loss is known as the normal loss that are inherent in the production process and cannot be eliminated. These losses occur efficient operating conditions and are referred as normal uncontrollable losses. Just take a fabric. So when you want to sew a frock, what you are going to do is you are going to cut according to the block. When you are cutting it, you can see several pieces are going away, which are unwanted for the block of the frock. However, in the manufacturing or in the tailoring process, these are normal. That's why it's known as the normal loss. As you can see, here there is a carpenter. When a carpenter is going to make a chair, he have to cut the timber according to the measurement. When he is cutting the timber according to the measurement, there may be some timbering parts is thrown away. It's normal. We can't attach all the things into the chair. That's what called the normal loss. It cannot be eliminated, it cannot controlled, and it is normal in the production process. Now let's see another type of loss. That is the abnormal loss. Abnormal losses can be avoided. That's why it's known as avoidable or controllable cost. And it is recorded separately and treated as a period cost. So you can remember in the second chapter, we have learned period cost as well as product cost. So here, this abnormal loss is treated as the period cost and we are going to report it separately. If the organization take necessary measures, these should be avoided. Such as if we have given proper instruction for the tailor, then he can reduce the wastage of that particular material. Now, in a garment factory, when we are taking the blocks of double XL, you can see from the top in the neckline, right? From the top in the neckline, there is a huge curve. So that particular curve is used in a small block to cut the hand measurement. Likewise, they can utilize the material into the most expected and most significant manner to avoid abnormal losses. So let's see how we are going to calculate the average cost per unit of output. Can you remember I informed you for the product, we are going to take the average cost per unit in the process costing. This average cost per unit of output is calculated by taking the total cost assigned for the product for the period divided by the expected output. Expected output does not mean the total quantity. It is the quantity where we are going to take the quantity of input to the process minus the quantity of normal loss. So whatever the inputs of materials, we are going to reduce the normal loss to calculate the expected output. There's a special procedure with regard to the abnormal loss. As I mentioned you earlier, there are some losses that are not expected to occur under efficient operating conditions. These losses are not an inherent part of the production process and referred as abnormal or controllable losses, such as incorrect cutting of cloth, improper mixing of ingredients. So in this year, you can see when you're preparing for the new year, if you have mixed different ingredients in improper manner, the output can be totally different. You are expecting to make a cake, but at the end, you can see a bulldog. Likewise, the abnormal losses can be avoided with the proper efficient operating conditions. And abnormal losses are not included in the process cost. So it is removed from the appropriate process account and reported separately as a abnormal loss. So you can remember this is treated as a period cost and written off in the profit and loss account at the end of the accounting period. Now let's see how we are going to account for the scrap. The damaged goods can be sold as scrap. Revenue arising from the scrap should be treated as a reduction in cost rather than an increase in sales revenue. So in this scenario, cost per unit of output can be calculated by taking the total cost of production and deducting the scrap value of normal loss. And we are going to divide it by the expected output. So you know expected output means the total input minus the normal loss. Now let's see how we are going to record the abnormal loss with scrap value. So the relevant cost per abnormal loss is going to debit to the abnormal loss account and we are going to credit it to the process account. And the scrap value from the abnormal loss is going to debit to the cash account and we are going to transfer it to the abnormal loss account. The balance of the abnormal loss account is transferred to the profit and loss account. If the scrap value is greater than the loss value, then there will be a profit which is B in the income statement or the P&L. Now let's see how we are going to treat the abnormal gain. An abnormal gain result on occasions that actual loss in the process may be less than the expected. The value of the gain is calculated in the same way as abnormal loss and removed from the process account. The resulting gain is credited to the profit and loss account. Unit cost is not changed due to abnormal gain. And this gain is considered as a benefit to the manufacturer. Abnormal loss is an unpredictable loss. Abnormal gain is where we have expected some loss abnormally. However, we are able to reduce that particular loss. So we have a gain out of it. So this gain is considered as a benefit to the manufacturer. So let's see how we are going to account for abnormal gain. So the relevant cost per abnormal gain is debit to the process account and credit to abnormal gain account. Then the loss of income arise due to abnormal gain is debit to the abnormal gain account and the scrap sales value will be credit to that particular sales account. Then the balance of the abnormal gain is transferred to the profit and loss account as same as the abnormal loss. So let's see abnormal gains with the scrap value. The only difference between, right, there is any losses which may have a scrap value. The cost per unit is based on normal production cost per unit is not affected by the abnormal gain. And here the process manufacturer's objective is to produce cost per unit based on the normal operating efficiency. Now let's do this calculation. Here, the normal losses are the losses that cannot be avoided. And this should be absorbed by the good production. The abnormal losses can be avoided and it should be recorded separately and treated as a period cost. So here you can see as inputs, we are going to put 1200 liters at a cost of pound 1200. So we are expecting 1/6 of the input will be normal loss. 1/6 means 200 will be a normal loss. So the actual output is here 900 liters. Now you can see out of 1200, 200 is normal loss. So the actual output here or the expected output here is 1000. Then the cost per unit is input divided by the expected output. So I am going to put the calculations here so you can understand it easily. So here it says the normal loss is 1/6 of the inputs. So here we have 1200 liters as the input. Out of that, 1/6 is the normal loss. Then the normal loss is 200 liters. Right? So here the actual output is 900 liters. Now let's calculate the expected output. I told you earlier the expected output is the inputs minus the normal loss. So here as the input, we have inputted 2200 liters. Then the normal loss is 200 liters. So the expected output here is 1000 liters. Then, now we are going to calculate the cost per unit. We are going to calculate the cost per unit. So, the cost per unit is the total cost divided by the expected output. So here you can see they have input pounds Here in this one, I can't find the currency value of the pound in the keyboard. Therefore, just I'm going to use that particular value. 1,200 is the total cost. From that one, we are going to deduct the expected output. That is 1,000. So the cost per unit here is £1 and 20 penny. So you can see in this one, they said they are going to actually produce 900 units. So 900 into cost per unit, £1 and 20 penny is the cost of completed production. So that is 1,080. Hope you can see it. Now here, just see this one carefully. Here as input, we have put 1,200 liters. Normally we know that input should be equal to the output. Now let's see whether it's correct. Here, as the normal output, we can see 900 liters. And at the same time, we can identify a normal loss, which should be treated as same as the output, which is 200 liters. So when we add the output 900 and normal loss 200, we are just getting 1,100 liters. Now just compare the input as well as the normal output. Input 1,200, whereas the total output with the normal loss is 1,100, which means there is a 100-liter difference. This 100-liter difference is known as the abnormal loss. So the abnormal loss can be calculated like this as well. From the total input, we have to reduce the output plus the normal loss. So 1,200 minus 1,100 means we are getting a difference of 100 liters. we are getting a difference of 100 liters. So this is known as the abnormal loss. Right? Then this abnormal loss should be cost in the same manner as the actual output. So we are going to multiply it with the cost per unit. Now, I hope that you can clearly understood how to calculate the expected output, then how to calculate the cost per unit, how to identify the abnormal loss, and how we are going to cost the cost of completed production, cost of abnormal losses separately. Go through it different times and go through it carefully and thorough it up how to calculate the expected output, cost per unit, and cost per completed production and abnormal loss carefully. Now, if we create a process account using this, it would be like this format. So here, what we are going to do is we are going to put the input cost. Here we have to put the column for represent units. So you can see 1200 is the 1200 liters which we have used as input. So we are going to put the value into pounds, that is 1200. All the inputs are come in the debit side of the process account. Now let's look at the credit side. In the credit side, we have calculated the output cost per unit. So the output transferred to the next process is 900 liters and cost per each liter is £1 and 20 penny. So the total cost is 1080. Now we know that there is an abnormal loss, which is 200. That 200 is 1200 into 1/6 of it. However, we can't see any scrap value or selling value. So it is blank. Now, when we balance this one, we can see there is a 100 abnormal loss. So this 100 abnormal loss, we are going to treat as same as the output. That's why we are using the same cost per unit. So the abnormal loss cost is 1020. Altogether, you can see the debit side is equal to the credit side of the process account. Now, in the same example, let's assume that we are going to sell the normal loss. So here, we are going to sell the normal loss at 50 penny per liter. Hope you can see that area. Scrap value, right, of loss in process is 50 penny per litre. Now, when we can sell the normal loss and we can earn a scrap value, the cost per unit calculation is differs. From the cost of production, here what we are going to do is we are going to deduct the scrap value of the normal loss. So here we are going to deduct the scrap value of the normal loss. So I have highlighted it in orange color. You can see it clearly. So you can remember as the cost of production, we have get, right? We have earned a particular value. So from the particular value, now what we are going to do is we are going to deduct the scrap value. So let's see how we are going to calculate it. So here, right, the output is 1000 liters. Now let's see how we are going to do it. First, we are going to calculate the expected output. You know, expected output is the total input minus the normal loss. Expected output equals input minus normal loss. Right? So here, the input are 1200 liters. From that, 1/6 is the normal loss. Since we have calculated it earlier, you can remember the normal loss is 200 liters. So, the expected output is 1000 liters. Now, let's calculate the cost of production. So here you can see input are 1200 liters and the output plus the normal loss equals 1200, which means the output is 1000 plus normal loss 200 equalized to 1200. So you can see there is no abnormal loss or gain because these values are same. So the cost of the input should be the cost of production as well. So the cost of production here is 1200, which is same as the input cost. And from this value, we have to deduct the scrap value of the normal loss. Normal loss in quantity is 200 and it should be multiplied by 50 cents. So when we multiply 200 by 50 cents, you can see 100 is the value. So 1200 minus 100 is the 1100. This is how we have arrived at the 1100, which means the cost of production less the scrap value. Now you can see how we have arrived into the cost per unit. Cost per unit is the cost of production minus the scrap value, that is 1200 minus 100, which is 1100, and it should be divided by the expected output. Expected output is the input minus the normal loss. Go through this carefully. So now you can see the process account. So you can see the input here. So we have input 1200 liters with 1200 pounds. So this value should be the output of the total process. So here it's mentioned that 1000 is the output which is transferred for the next process, and there is a 200 normal loss, that is 1/6 of the input. Then this can be sold at 50 cents per each, so we are getting 100 pounds as the normal loss scrap value. Then we have used a formula to calculate the cost per unit, that is 1 pound and 10 penny. So when we multiplied it with the relevant quantity as the output transferred to the next process, we are getting 1100. So you can see both debit side and credit sides are balanced. Now, in this scenario, you can see we are getting the sales proceed from both normal and abnormal losses. So here, as the example 1, we are getting the output as 900 liters. And we have counted that abnormal loss is 100 liters. And earlier, the cost per unit we have calculated 1 pound and 10 per liter. So remember that sales value of the abnormal loss should be offset against the cost of abnormal loss. Please remember this point carefully. Now you can see the process account. So in the process account, first, as earlier, what we have included is the input. So here input 1200 liters at 1 pound each, 1200 pounds. So here we can remember that normal loss is 200, which is said at 50 penny. So the total amount received is 100 pounds. So we have calculated the output. Actual output is 900. Then we have calculated the cost per unit, £1 and 10 penny. So the total output transferred to the next process is 990. Abnormal loss should be treated as same as the output. So the abnormal loss is here 110. So I'm going to put the expected output. So expected output is the input. Since you are familiar, I'm going to use the shortened forms. Inputs minus the normal loss, right? So here inputs are 1200. From this, we are going to minus 200, which is the normal loss. So the expected output here is 1000 liters. Then let's calculate the cost per unit. Cost per unit is the total cost of production here. Rather putting the total cost of production, I'm going to use TC, total cost, minus the scrap value. So the total cost here is 1200. From that, we are going to deduct the scrap value, which is 100. So this value should be divided by the expected output. Which is 1000. So when we divide 1100 by 1000, we are getting 1 pound and 10 pence. Hope you have a clear understanding how we are going to record a normal loss with scrap value, then abnormal loss, and how we are going to identify cost per unit when there is a scrap value as well as the abnormal loss. So now what we are going to do is we are going to create the abnormal loss account. So we are going to credit the process account. Then we are going to transfer it to the abnormal loss account as the debit balance, 110. So as I told you earlier, the abnormal loss of 100 can be sold 50 penny each. So 100 into 50 penny is 50 pounds. This is the scrap value. So you are getting 50. Now, difference between the account is identified as the loss of the abnormal. So this is transferred to the income statement. This 60 is transferred to the income statement or the profit and loss account. This is a cost. Therefore, we are going to treat as expenses in the other expenses category. So now let's see how we are going to record abnormal gain. So here I'm going to use the same example. So here we are going to input 1200 liters at a cost of 1200 pounds. So here the output is 1100 liters and normal loss is 1/6 of the input. So it says the scrap value is 50 pence per liter. Now let's calculate the cost per unit. So here, first we are going to take the total cost, and from the total cost, we are going to deduct the normal loss value. So from the, now I'm going to calculate the cost per unit. Cost per unit is the total cost minus normal loss scrap value divided by the expected output. So here, the total cost is 1200. From this one, we are going to deduct the scrap value of the normal loss. So here, 1/6 of the input is normal loss, which is 200. It should be multiplied by 50 penny. So this value should be divided by the expected output. Expected output is the input minus, right? Here, input minus the normal loss. So here, the inputs are 1200 liters. From that value, we are going to deduct the normal loss 200. Which means 1200 minus 100 should be divided by 1000. That is 1100 should be divided by 1000. So you are getting here the cost per unit as £1 and 10 penny. Right? Now let's see how we are going to record it. So let's see whether there is abnormal gain or not. So as I mentioned you earlier, inputs should be equals to the output. Output plus the normal loss. So here input is 1200. So the output is 1100 plus the normal loss of 200. So you can see there is a disparity or a difference between the inputs and output. So input are lesser than the output and normal loss, which means there is a 100 abnormal loss. Abnormal gain is there. Abnormal gain 100. That's how we are going to identify the abnormal gain. So even though we have input 1200 liters as output and normal loss, we have generated 1300 liters. So there is an abnormal gain or benefit out of this production, which is 100 liters. So now you can see the process account. So in the process account, as earlier, we have put the input cost 1200. So the value is pound 1200. Then we have calculated the normal loss, which is 200 units. And we are going to scrap it as 50 pence each. So we are getting 100 pounds. So you can remember we have calculated the cost per unit of the output, which is £1 and 10 pence. So we are going to multiply it with the output quantity 1100. So we are getting 1210. When we add them together, we are getting in the credit side 1310. Now you know that debit side should be equal to the credit side. So the difference between the input cost and the total will give you the abnormal gain value. That is one method. The other method is what you can do is you can calculate it as the based on the cost per unit. So here the abnormal gain is 100 units and cost should be valued as same as the output, which is £1 and 10 pence. So the abnormal gain is 110. So now let's see the abnormal gain account. In the abnormal gain account, we are going to put the normal loss account, right? So in the abnormal gain account, we are going to transfer the debit balance is there in the process account. We are going to transfer it to the abnormal gain account as the credit balance, which is 110. So out of that, you can see 100 into 50 is the scrap value. So 100 into 50, we are going to transfer into the abnormal gain account. Right? Then what we are going to do is the difference between the debit side and credit side, we are going to transfer to the income statement or profit and loss account. Let's see the normal loss account. So in the normal loss account, we are going to credit the process account and we are going to transfer it to the debit side of the normal loss account. So out of here, we can remember, right? This 200 normal loss is selling in 50 each. So here you can see the normal loss transferred is 100 reflect the 200 into 50. 50 pence is the 100 in the normal loss account. This is a combination of the abnormal gain. So the abnormal gain is 100. 100 can be sold 50 penny each. So we are getting 50. And the balance is the cash we are receiving. That is 100 into 50 each. So we are going to debit the cash account, then we are going to credit the normal loss account. Now let's start with this example 1. In this example, I have included the abnormal loss with the scrap value. So here, the process 1 has a normal loss of 10% of the inputs due to quality control rejections. At the end of the process, output from process is transferred to process 2. Input material 1,000 units, rupees 2,000. Conversion cost. Here the conversion cost include the labor as well as the overhead. So the conversion cost is rupees 3,000. Output to process 2 was 850 units. You are required to prepare the relevant accounts when all the rejections have no value, which means the normal loss have no value. And the next one is this normal loss can be disposed at a cost of 50 pence, 50 cents per unit. So earlier, what have we done is we have solved them. Now we have to dispose it at a cost of 50 cents each. Now let's see the calculations. So here, let's calculate the normal loss. It is 1,000 units into 10%, which means 100, isn't it? This is the normal loss. Now, let's see, are there any abnormal gain or loss? Abnormal loss or gain can be calculated by input minus output plus the normal loss. So here input is 1,000 units. The output is 850 plus the normal loss of 100, which means 1,000 minus 950. So we have abnormal loss of 50. These are the basic calculations you can do out of the data given in the question.